Good evening. So tonight we're going to talk a little bit more about personal finance, in particular mutual funds. But before we get started on all that, I want to make sure that we look at the project rather than wait to the end. We'll just push it right up here to the front. Um, the project is it's pretty flexible. I mean, I was writing to a student today in an email that you're kind of the customer for this project. What you put into it. Well, there's two things you should get out of it. At the end, one is fulfilling a course requirement, but the other part is kind of giving yourself a plan for your future. Now, I mean, there's so many variables, and right now we're in the middle of a situation that none of us ever would have forecast even a month ago. But it is what it is. But those people who were living paycheck to paycheck and had absolutely no plan, it's kind of tough to adjust to a plan or adjust from a plan if you never had one in the start. So I'm not saying this would necessarily save you, but some people are going to come out of this thing with some whatever inconveniences, and for other folks, it's going to be a huge life changing event. I do think the economy is going to bounce back incredibly strong after this, and you know, I think a lot of people are trying to poise to be ready to go when that happens. But anyway, these things, this is a pretty big shakeup. I'm not gonna fool you. Anyway, back to the term project. So the the one thing that you'll get out of this is a grade, but the other one is a project that hopefully will have some validity in terms of things that you've thought about, and sometime in the future, and it may be now if you're somebody who's already immersed in a career, but for a lot of you, in fact some of you are even in high school, taking the class early, you're quite a few years off, but it's never too early to think about this stuff and kind of listen to the terms, and you know um, things will make more sense as life goes on, and everybody ends up knowing what you'd call financial literacy, but some people learn those things, those lessons early enough to act upon them in their life, and other people, they end up being coulda woulda shoulda kind of things, where they should have done it this way or they would have done it that way, and you know they made a few mistakes along the way. So in the mechanics of the paper, the paper itself, there's some guidelines here. There's some hard and fast kind of things in terms of content. It's got to be 4 or 5 pages. There's just no way, regardless of what you're going to do, that it's not going to have some meat to it. Also, it's not supposed to be just a checklist thing. Now, you may in your outline make it a checklist, but at the end of the time, it should kind of flow together like a paper. Um, so for a lot of you, and again, this isn't a one size fits all thing, but for a typical college student, 5 years out is because, if you're in college now, your first year out, you're just getting into the, assuming you make it through in 4 or 5. Anyway, and you're getting into your career, and hopefully you're smart enough not to accrue a whole bunch of student debt, and you're going to move on and come up with some goals. So depends on your life, what you have planned. A lot of folks would you know be looking at marriage and children and those kind of things. Retirement, certainly. Again, the retirement bit is if you have that nest egg available for retirement, if something happens in the interim, you can always draw upon it. And then also taking care of the people around you, in terms of insurance, in terms of not leaving folks in debt if something were to happen. We talked about student loans. And I don't think the elections are going to help anybody out this year. The folks who are promising student loan forgiveness, I think they're all kind of gone by the wayside now. But there are still some mitigating things. One, not to take that much debt, and I'm not whatever. I'm not trying to have people focus their career just to get out of their student loans, but there are some career fields, if you're an educator, going to certain places or going to the military or doing something like that, where there is loan forgiveness, or at least, you know, stalling it out a while. Anyway, that's something that needs to be taken care of, or it's definitely going to affect your ability to save while you still have those loans hanging out there. Social Security, this gets to be more of an education. You go to the Social Security website, and you can look at all your data, or you can just look at the general specifics, and you'll find that you don't really want to be relying solely on Social Security. It's a safety net, but it's not a comfortable place to be. It's not how you want to spend the what could be a fairly reasonable time of your life. And anyway, life insurance. There's a lot of individual choices in there. I kind of spoke enough about the financial sense of term insurance, but whatever you choose, you do have to have some type of insurance or some sort of self-insurance plan, but you owe that to your loved ones. Investment portfolio. So that was another question that came up. When we talk about investments, what would you want to do? And like I think a lot of people, well, we'll talk more about this, but a diversified account is kind of where you want to be. Maybe some of the stuff in the market, stocks, bonds, mutual funds, but also probably some real estate and maybe a certain amount of cash and other types of options. But even within those fields, you're going to want to diversify as well. So not having all your eggs in one basket is what they say. Um, Government-backed securities, real estate, other ventures. Yep. Career field. You can look on a website. The example I always use, and some people are going to hate me about this, but I love animals, and man, being a vet would be very cool. But the pay scale between being a vet and being a doctor is drastic. Vets, unfortunately, there's not much of the way of insurance. There's not much of the way of, people basically pay cash out of pocket for a lot of those expenses or whatever drives the career field. But vets are not, given the amount of schooling they go through, um, they may not be compensated to the amount that a lot of people would think would be fair. So, but the reason I bring up this example is one of my daughters worked for a vet, and this guy all he did was complain about how he should get paid more. Well, no, what he should have done was he should have, gone into that field because he loved animals and that's what he wanted to do. And if he was concerned about money, after going through 8 years of school, he could have spent, 10 minutes on the internet looking at what an average vet gets paid and being aware, that he was going to be disappointed his whole life. So, now, if there's something you have a calling for, and I'm not trying to tell you to just go after the money making type careers, but if it's going to be something that's not going to make much money for you, you're going to have to be even smarter with your investing. There's a few books out there, The Wealthy Barber and some other stuff about people who, they don't make a whole bunch in their chosen field, but they invest well and they, live wisely and that's how they do it. Or, a second gig. I think I've got 3 jobs right now. I mean, one of which is this, but I also have, small business stuff. I've got a regular plus a military retirement. So, I mean, I like that diversity just because I go nuts doing just one thing over and over again. So, you may come up with some sort of combination. That's a lot more typical, and in these times where even gig kind of economy kind of stuff. But you this whole situation we're in right now is kind of an eye opener. That's really given the service industry is really kind of a bad name because you hopefully anybody in those type of fields has some sort of backup because this is going to be a rough time. Okay. Retirements. Good luck. If you're in a company that has a traditional retirement, but for the most part, those are not the case. But anyway, you can see what's happening here in terms of when I'm going through these points. I mean, you're gonna elaborate basically on all these points, and it doesn't necessarily need to be in this sort of order, but you're going to address these sorts of things. We're going to talk about tax deferred compensation, right? Or some of the different IRS programs out there. For example, somebody could write a great paper and they'd say, yeah, I'm going to save, money for my kids' college and, in stocks or mutual funds or whatever. And that would basically get you a B, if that's where you left that. Because if you explored it a little bit further, and it doesn't take much, you look at some of these websites that we'll talk about tonight, you'd realize that there's certain programs like 529s and some other plans that if you invest your children's money in those type of plans, that their earnings are tax free. So, you do the right thing for your kids and you generate a pretty good chunk of money. Well, it would have been quite a bit more money had you put it in the right type of fund. So you could still buy the same stocks, the same mutual funds, the same whatever, but if it was characterized in this case as a 529, they wouldn't have to pay the tax on it as long as it was used for educational purposes. So anyway, and 401ks, 403bs, there's a typo in there. TSP is just a thrift savings plan. It's a military deal, but these are ways to save for retirement. And again, when you're doing it this way, it saves you on taxes because it's taken out of your current income, and we'll discuss that a little bit more. Couple paragraphs in there. Da, da, da. Again, don't put down your own, info. I don't need, specifics on your own situation. You just say, yeah, my friend Bob or whatever. This is because you really don't know, especially if you're guessing 5 years out. You put down a bunch of personal information. Number one, it's whatever. It's not. There's no value added to using your actual specifics. But what you do want to use is somebody who's going to be in a very similar situation to yourself. But I don't need to know what assets you already have or something like that. Now, your friend Bob may have a similar starting point, but again, I'm not going to show your projects to other students, but just the same to keep your privacy. Just keep the information fairly anonymous. And that's about it. So again, if there's going to be more questions coming up, but I'd say that my usual reply on these emails is, yeah, that's fine. Whatever you think. Because people will come to me with well, this is what I want to do. Or I'm a foreign student, or I've got this unusual situation. Well, then do something that's useful to your situation. Most people already have an idea of what they want to do, and they're just looking for an okay, whether they can tailor it to their situation. And, in just about all cases, I will agree to that because it's, again, the overriding principle is that it's useful to yourself. All righty. So now we're going to talk about mutual funds. Mutual funds are useful. What mutual funds do, they can be a collection of almost anything, but typically anything in terms of investments. But typically they're equities, they're stocks, and equities and stocks are the same thing. If you own stock in a company, you have an equity position, right? So what they can also be is they can also have, certain mutual funds can have bonds under them. They can have, real estate type investments under them, but 90%, 99% or so of mutual funds are conventional stock ones. Now, there's so many mutual funds. There are more mutual funds, individual mutual funds, than there are corporations out there. So, mutual funds, now again, in terms of corporations, there's publicly traded corporations that could end up in a mutual fund, that sells stock. And then there's privately held corporations where that stock is not out there on the exchanges. So that's just the difference with those. This is just sort of shows you the potential of what can go on with the stock market. Keep in mind this, sort of drop, these things happen. But the alternative is not to, stay on the sidelines because you don't really know where these points are going to occur. And market timing would be jumping in and jumping out. And if you're in it and you're in it, this is back 2007. If you're down here at the bottom, at this point, stay in it and you'll hopefully will be a V-shape recovery, maybe in a check mark, and we'll be off to the races. Because the all the other outside of this Corona business, the economy is poised to be very strong, and the U.S. is even stronger. It's the safe haven and all this stuff. So once we get through this, which I'm optimistic, a couple weeks a month, things start turning around. Things financially could take off quite quickly because, as some of who may not be working right now, the quicker we get back to work, the better things are going to be for everybody. But anyway, I know a lot of people are different people have different effects due to this situation. So this is what I was talking about. Stock mutual funds are the primary thing, right? Now the reason why you'd want a mutual fund versus individual stocks is because mutual funds would be a collection of individual stocks, so they can be I mean, it's almost hard to define because you can make up a mutual fund of any collection of stocks you want. But anyway, let's say that it's got 40 or 50 different stocks under one mutual fund, and so that mutual fund company owns stocks in all these different companies. They combine them all together, and then they sell shares out of those combinations of stocks to you. And when you buy that, you're buying small chunks of every company that's held under that portfolio within that fund. And the beauty of that is that there's going to be winners and losers amongst individual companies. And it really is poor to have that one company that happens to tube. Let's say the economy's roaring along and your company, for some reason, if you're all in one company, you've got, all your investment with a single company, and that company goes out of business. That's very bad. What you prefer to do is if you invest in a broad range of companies, then as long as the overall economy goes up, if one of those companies happens to go out of business, the other companies that are probably in that same field are going to take up the slack, and you're going to be fine. So, plus you have professional management to a certain degree. You can also have index funds, which a lot of you have probably looked at the podcast, and we'll talk a little about mutual funds and index funds and managers. So bonds could also be under it, but managed by professional portfolio managers. Now, if it's an index fund where they just kind of buy and hold, there's not a whole lot of management going on. I mean, that person's just selecting the stocks, buying them, and then, backing off. And since they're not doing a whole lot of work, they don't get a whole lot of money after that initial buy, so the expenses are quite low. And that's the reason they do that. Some of these other guys that are, churning the stocks, buying and selling and doing all kinds of analysis and all kinds of work, part of that is that they're generating some expenses doing that. And so if they're very profitable, it's worth having the person do it. But if they're just generating a bunch of expenses through a whole lot of effort, and again, this gets back to the podcast that was the homework assignment that is posted again at the end of this assignment. Motives for investing in mutual funds. So small initial investment. So, you can look at a mutual fund company and it may say, $1,000 minimum, whatever, some relatively high dollar figure to start up an account unless you set up with some sort of automatic investment plan, and then it's nothing, 25, $50. And that's what they want. They want, regular investments. And you kind of want to do that as well. It's called dollar cost averaging when you do that. And the theory being that when stock prices are going up, let's say you're investing $50 a month. When stock prices are going up, you're buying just a smaller amount of shares because they're more expensive. But when the price goes down, you're buying more shares, because the share price has gone down. So over the long term, that tends to stabilize the prices that you're paying for it. Anyway, that's a concept. Ideally, I would like to buy more when it's cheap and buy less when it's high priced. But again, that timing and that guessing when that's going to happen is a difficult part to do. Expertise of the portfolio manager. So some of these guys make quite a bit of money because they're good. Some of them make quite a bit of money and they're not good. So that's the whole problem, is that these guys they're kind of like sports coaches. And if the team is winning, you don't mind paying a big salary to the person, but if they're not, you know, you might want to go to some other fund. So we'll look at some of the review sites that kind of grade these guys' performance, and it's fairly easy. I mean, the metrics are out there based upon are they making money for the shareholders or are they not? Specific investment goals. So all the different funds, it's all marketing. You'll have some funds that are meant to be very stable. You'll have other ones that are meant to be very aggressive, but obviously that's going to entail a bit more risk. But or they could be socially responsible, or they could be in a certain sector of the economy. They could be in high tech or medical or something. They could be in certain regions of the world. There's so many ways to split it up. Now, as opposed to stock prices that are per share, under mutual funds, it's the net asset value. So what they do is they add up all the shares that are under that fund and they divide it by the number of shares and they come up with a dollar figure. This is not such a big deal. It used to be a big advantage over stocks that you could buy, say, an even amount like $50 per month. Whereas in the stock market, they want you to buy in even units of shares. But now that everything's kind of digital, if you want to buy, 2.3 shares of something, well, they wouldn't allow that. They'll normally want you to buy whole shares. But if you want to buy, 3 or 7 shares, something like that, that's allowable. In the old days, it used to have to be, round lots, like, units of 10 or 100 for the shares. So it just made it more awkward. And then you had to deal with these, stockbroker folks to buy stocks, whereas mutual funds have always been more automated and bought over the phone or online now. So as automation has made stock buying easier, the advantage of mutual funds in terms of convenience has kind of gone away. But the diversity aspects of it are still super important. Okay, open versus closed-end funds. Some funds, what happens is if you say you see some fund, you really want to invest in it because it's doing really well. And everybody, and across the states or across the world sees this and they dump a whole bunch of money into it. Now all of a sudden you've got this mutual fund that's supposed to be invested in small companies. Now it's got billions of dollars in assets. It's this elephant. And every time it makes any kind of movement in any sort of market, it distorts the prices and does everything else. So you'll see the term open and close funds. Sometimes they'll close funds. Sometimes they'll use that term when they're saying you have to be part of that company. You'll see these terms sort of used interchangeably. The term when mutual funds that you absolutely need to pay attention to is loaded versus no load funds. There's really no reason for you to be paying a sales commission. So I wouldn't get too wrapped up with the open end versus closed funds. anyway, repurchase them, sold in stocks. I generally do not come across funds like this other than some of these funds that, um, Fidelity Magellan was one that was out there that you couldn't get into. Berkshire Hathaway, Warren Buffett stuff. You couldn't necessarily get into it because they were no longer accepting people. But this term right here, load versus no load, is huge. Okay, so no load funds, like I say, there's whatever 10, 15,000 mutual funds out there just in the U.S. market, and some charge a commission, and some do not charge a commission. And that commission in mutual funds they call a load, and you do not want. Okay, so we could have an episode right here. Anyway, you'll get a new instructor by the end of the term. Um, so anyway, stay away from anything with a load on it. What happens when you're investing? If you pay a commission, you may think, oh, that's kind of a drag, whatever, 3-5%. Well, the problem is that commission comes off the front end. It comes off the money that you're initially investing, which is the worst time to do that. Time value of money and all. When you're just starting out and you've got this seed money, you're starting the account, and they're taking a big chunk of that for themselves. It's unnecessary. And if somebody's trying to push that on you, well, the reason why they're trying to push it on you is because they get a commission. The no load funds, people aren't pushing that on you because it's not. And there is no commission to be made. You just go directly to the company, and it's not that hard. I'll show you how to do it. Okay, so this is just an example of what happens. This guy's trying to put $5,000 in a mutual fund, no load, so zero, right? He gets all 50, makes 10% on his money. He's very happy. This guy pays a load, so he gets that same $5,000, but he pays 4%, goes to the broker. So $200, 4,800. Time value of money, all that happens. At the end of it, what's his return? 5.6% versus 10%. 10% is good. 5.6 is you took quite a bit of risk. You had your money in the market and you only got 5.6%, and this guy got $200 out of you. So anyway, no need for that. Expense ratio. So the mutual funds, is part of putting this together and doing their management. They have expense ratios, and you need to look and see how those things compare. Now, again, I don't mind paying a higher expense ratio if there's some rock star guy getting super results. It's like they talk about CEO compensation where it ought to be capped. Again, it gets kind of political, but if somebody is running the company and making tons and tons of money for the shareholders are going to reimburse him well because they don't want to get him hired away by him or her hired away by another company. And so, anyway, people who have skills, in a perfect world should get paid more. Now, again, if it's one of these things where, it's somebody who's the company's losing money and they're getting paid an exorbitant salary, that should be squared away. But to just arbitrarily put a cap on it, anywhere, arbitrarily say whatever expense ratio is too high, well, what's the yield? If he's charging 1.5 and not getting much of a yield, yeah, then that he should have a lower than average expense ratio. But if he's getting triple the rate, triple the earnings that other people are, well, that person deserves to be compensated. And there you go. Now, this is just a kind of a blanket statement that is actually kind of backed up though by the the bet on that podcast. If a fund does have lower expense ratio, it should outperform the other fund unless that person who is managing it is doing an exceptional job. So anyway, it's hard to make that as a blanket statement, but all things being equal, yeah, that could happen that way. Mutual funds. So they'll typically have mutual fund kind of families. They'll have a growth fund. So growth means, companies that are probably not going to be paying a dividend, right? They're not income funds. These are growth funds. These are something, and categorically, you know, younger folks should probably be involved in growth funds because growth funds are going to be a little bit more aggressive, a little bit more risk, but you got a lot more time to recover. So in the long run, you're going to go through some volatility, but you should end up way ahead. Now, somebody who's older to jump into growth funds, the advice would be probably not to do that because there could be a downturn, and although the fund might get back up to where it was, 10 years down the road, that person may not have 10 years before they want to start drawing that money out. Capital appreciation fund, yeah, very high rate. So again, these are all, superlative, very high versus, above average. And it gets even worse when you look at the funds. So we'll look at a few more. Sometimes they split them up on the capitalization. So how much, uh, in reserves that company has. How big is their capitalization? So small caps, mid caps, and then there's also obviously they don't have large caps here, but that's one. Equity income funds, which would probably be, most of the time those are the large caps. These are big mature companies that aren't expanding anymore, and they're not using the profits to build new facilities. They're paying dividends. There are actual dollar figures that go along with small, mid, and cap, but not super important. But again, for me, I've always been small cap or capital appreciation. I've never haven't heard them call that too much, but generally a growth fund or aggressive growth and small cap, smaller businesses. Now these other ones, so balanced. Sure, you could put both in there, have some growth and some income. Sector funds. It could be in here they're saying technology, it could be, minerals, it could be defense, it could be whatever. And we'll look at some of the funds. So this will be more, I've got some of the websites loaded up. We'll take a look. So index fund. This is something that's because the market has just been going up until recently. It didn't really take a high paid stock picker to figure out what companies are going to go up. They're all kind of going up, and these index funds, there's an index out there like let's say Standard and Poor's or the Russell or something like that. One of these indexes out there that's traditionally just been used to kind of gauge the market direction. It wasn't used as an investment itself. Well, what these guys have done is set up actual funds that mirror. They buy everything within a certain number of shares of everything within that index, and they buy them and hold them, and their job is done. And so the expenses, once they do that initial buy, there's not a lot of management going on, so the expense ratios are quite low. And if the overall economy is going up, that index should go up, and so it should be quite profitable. And again, that gets back to the podcast. International stock funds. So yeah, there's some, we're kind of splitting hairs here, but there's international and then there's global. Okay. International would mean everything has got to be outside of the United States. Global would mean everything, well, it could be anywhere, including the United States. It's one of the globe as well. So small thing there. Socially responsible stock funds, mutual funds that screen out firms. Some view as expensive. I'm not earth rapist or anything here, but I'm just saying it's very difficult to figure out which companies are. Some have a very public face and some do not. You'll see these guys running sweatshops, and it's hard to think of. many consumer products we have that don't have some dirty laundry out there. So if you can find some of these funds that do a good job of it and are legit, then that can be a smart way to go. And it's also smart for investing too. I mean, companies not. But what kind of irks me about this is that they, make the illusion that some companies are, polluters and that's how they're making their quick profits. Well, doing that kind of stuff is not very profitable, not in the long term. So good companies, profitable companies are generally socially responsible. But I'm sure there's exceptions out there, but whether they're contained under these funds, I'm not sure. Other types of funds, small cap growth fund, I mean, it can be any kind of thing. Exchange traded funds, what happens here is because mutual funds are so large, some of the brokerage firms want to get in on the action, and they'll say, "Hey, look, we can offer you a product that's just like your mutual fund, but you can trade it just like you can stocks, so you get that thrill of trading. Plus, since it's traded on exchange, you could trade it within the day, you know. With mutual funds, because they aren't meant to be, traded, buy and sell and do all that kind of stuff from the end consumer. This is supposed to be something you're buying and you're holding for 40 years or something. Those features of being able to trade through the day are typically not important. And so when you sell a mutual fund, you sell sometime before the close of that day, and your order is not really executed. You just get the end of the day closing, which sometimes markets can be volatile and that can change quite a bit by the end of the day. So, you know, you might want to, if you're going to sell something, sell it towards the end of the trading day. But just the same, it's a mutual fund that you've had for many years, and we're talking minute differences. But anyway, some people who kind of want the thrill of doing trading on the exchanges with their mutual funds, they have a product for you. Yeah, they're showing Vanguard. Vanguard's just one company. Types of mutual funds, bond mutual funds. Just since we're there, you can get treasury bonds. So mutual funds that have those kind of bonds in them. Um, Here's some mortgage bonds. So Ginnie Mae's and corporate bonds. So they can be under mutual funds as well. Junk bonds, so you could put those under a mutual fund. But that whole concept of diversity, this is kind of what happened in 2007, where they got these mutual funds that were made up of junk bonds, and then they, kind of relabeled them, and they said, oh, they were risky, but now we've lumped them all together. Anyway, they're just kind of crappy bonds, and they ended up with just a bigger pile of crap, and it wasn't any better than the underlying securities. Municipal bonds could be put under that index. So you can put almost any investment you want under a mutual fund. Um, International bond. Now you get to worry about currency risks too. Right now, again, there may be some markets that you might think are doing pretty well, and I'm not being condescending here, but maybe Vietnam, someplace like that maybe is kind of up and coming. But the reason why I'm so confident about the economy rebounding is because the U.S. is kind of where the money is flowing into, and because internationally there's um, it's the U.S. is pretty strong, the dollar's super strong, and in times of crisis, people want to go to someplace that's semi-safe. Foreign bonds and maturity classifications. So just like other bonds, they can be lumped together based upon when they're going to mature out. Return and risk of a mutual fund. So it's going to be the same as the underlying securities, with not the exception, but the modification that it's going to be a little bit more diversified. Dividend distributions, capital gains distributions, capital gains from redeeming shares. So two different ways that you get a return. If they're selling, companies under that portfolio within the year, they may generate some capital gains, and then they may also have companies under that portfolio that pay dividends. And so at the end of the year, you're going to get a statement, and it's going to capture all those items. But it's really no different than a stock, but there's a lot more math going on at the company themselves because they've got all those companies that are nestled under that one fund. But you as the individual investor, not a big deal. Short-term capital gain, long-term capital gain. So 15% if it's long-term, 28% or whatever your tax bracket is if it's short-term. Some taxes to be paid. Risk from investing in a stock mutual fund. So certainly the market and trade-off between expected. So I mean, if you take no risk, you basically get no return. So what you need to make sure is, that your risk that you're taking is being compensated. So to take the ultimate safe route will not appreciate fast enough. It will not earn you enough money and will not overcome inflation, and then it'll be taxed. On the other hand, if you go too aggressive, the reason why you're getting a higher interest rate is because you're taking more risk. So you need to balance it out, and you need to perhaps even change it over the course of your life. There's quite a few funds that they have what they call a life cycle fund, and so you'll pick like a retirement date. You'll say, retire 2060 or something like that. They generally have an estimated year for when you enter the workforce based upon when you would retire. Pardon me. And if you do that, the mutual fund company should have you in growth investments when you're younger in your, younger years of your career. And then as you start to get closer to that target retirement date, they should switch you into more conservative investments. It's all marketing, it's all a strategy. The reason why I'm not, whatever championing it is because that's not what I do. I'm in pretty risky stuff all the time, but I also have a military retirement as a backup and some things like that. So you have to look at where you're set, but you have to know how much risk you can endure and how much risk you're comfortable with. Moderate growth stock fund, high stock. Yep. May also consider default risk. That's the company not paying back the bond. But with a regular mutual fund equity, the company may go, out of business. So lots of things can happen. It's no different than the underlying investments. So they're showing a risk versus a potential return. So the worst case they're saying is a foreign growth stock because growth stock is going to be the most aggressive. The foreign part, now you're going to also have to deal with a currency and politics you can't really control. Small country, they could nationalize stuff or do something like that. Technology, yeah, sector, you're all in one sector. Global stock. But again, more conservative is not always better, and sometimes you can diversify amongst these segments rather than be all in at a certain level. Bonds again. Long-term bonds, most sensitive. They're having to forecast way out in the future, and they're not happy with that. They're it's like giving a weather forecast for 3 weeks out. It's hard to do, and so they want to spend more time with that. Conservative, no default risk. Junk bond, high default risk, potentially high return. So I've never had junk bonds. Again, they might call them high yield bonds, but again, I'm not a big bond person. So T bonds, these are T bills, these are mortgages, some corporate bonds, and now we start getting into long term. So this company's kind of flaky, and you're investing in the long term with them. Now you're going overseas with it, and now you're looking at one little country. Again, diversification and not having everything in one of those extremes is probably the right way to go. So it's going to take more than just PowerPoint slides to make these decisions for you. But the good news is that all these companies who want to, you know, have you buy their product, they've got the websites out there to help you with that. Um, Past performance, but you got to temper this. You got to look and you do want to see some performance, but stock prices are based upon a forward-looking thing. Also, if there's been a management change or some market change, you want to know about it. Some of these folks, and that's where it's also helpful to kind of be aware as a consumer. You might look at a certain fund and you might say it's a mutual fund with quite a few retail products in it, and you might know some of these companies, and you might say, wait a minute, that's the new technology is going a different way. You might have, like, say, a technology fund, and it's got a bunch of Dell or Gateway or something, and the other one's got Apple or something. And you try not to get too personal about it, but you should know you know what company's coming out with a new product, and what company, what looks like a better mix of companies, because you can look at those underlying assets. We'll do that here in a second. Fees and expenses, and again, just make sure they're relative, that they're proportional to um, within the other funds. And also, um, if the company has high expenses and low performance, that's not something you want to be involved in. How to buy and redeem shares. Most of the stuff is quite easy. It can be quite automated. Okay, so they talked about Vanguard. Now they're looking at Fidelity. So, like anything else, there's going to be other companies. So these are Fidelity and Vanguard, the people selling you the stuff, right? So if you ask them about their own products, they're going to say they're fantastic. So that's why a company like Morningstar is something that you want to, um, you know, perhaps when you're starting to look at a new mutual fund, you might want to take a subscription with them, or get access to Morningstar information, because Morningstar is going to be a independent third party that's going to evaluate these funds against each other and give you more meaningful information. Quotations available from any one of the websites, and again, the same sort of chart is what you're looking for. So again, this tabular data is not as useful. When you can overlay a couple mutual funds against each other, it's far more useful. But they typically have a same sort of ticker type symbol. Here's a dividend. The last price up 17 cents for the day. I mean, the numbers are in there, but it's just not as user friendly. I backed up one slide. Year to date return, 3-year return, net change, net asset value, which equates to be like the stock price. That's just the calculation. Mutual fund. So this is a group of all the different mutual fund companies, Mutual Fund Education Association, I think it is. Anyway, they're tend to want to educate people on mutual funds, but it's put out by the companies themselves. Diversification, diversify across different funds. Um, Best strategy, I would not go with that because I don't want any bond mutual funds at this point. Diversity amongst different countries, you can do it that way as well. But again, if the money right now to be made is primarily in the U.S., you might want to do that. Impact of the financial crisis. There's always going to be a different financial crisis. Most mutual funds, most everything did poorly. So anyway, they're not giving you a lot of alternatives here. You could hold the money in cash, but when they pump in a bunch of new money, there may be some inflationary pressure. So there's not a lot of good places to hide when all the markets go down at the same time. International diversification across different countries. I had quite a bit of, because of the technology, quite a bit of things in China, but they were already kind of getting beat up before by the tariffs. But they'll probably come back. Yep. Most of these companies will sometimes will even offer funds that the competitors sell. That they'll you go to like the Chevy dealer and they'll have Fords on the lot or whatever. Some of the mutual fund companies will actually sell some of the other lots, and then some of these mutual fund supermarkets. But I've usually dealt directly with the mutual fund companies. Self-explanatory. Hedge funds, you'll hear that term a lot. Um, as you get into more aggressive funds, you'll find some that will more than just invest in aggressive companies. They'll use fairly aggressive strategies. So when you get the document that tells how the mutual fund will be managed, which is called the prospectus, when you get the prospectus document, it will kind of give the rules of the road in terms of what the investment advisors, the fund managers, um, you know, motives are, what their goals are, and what limitations are placed upon them. If it's a hedge fund, they probably can do all sorts of things, short selling and meaning selling stocks they don't have, anticipating a drop and doing some other things. And there's always going to be in the papers about certain people who make a ton of money doing that, but they don't tend to publicize the people who lose money. But I'm not saying they're, anyway, it's typically not something individual investors get involved in for a personal finance level because it gets more into speculation than in investing. Madoff, this is Bernie Madoff was a guy. Basically, people were getting 20% and they're exposed to very little risk, which from what I've said is wrong. I mean, how are you getting 20% interest when you're in this risk-free account? And what it was just a pyramid scheme. The people were coming to invest money, and that money was being given out to the established investors. And as long as new investors kept showing up, they'd get the new people's money, give it to the old people, and when the new people quit showing up, the wheels fall off the bus and the whole thing crumbles and people go to jail. But the underlying thing was that all these people who thought that this guy was just a genius, Bernie Madoff, he wasn't, and they should have known. I mean, they were taking their 20% yield year after year under the illusion that they weren't exposed to any risk at all, and nobody else was getting that in the market, and there was a reason because it wasn't really an investment; it was just a pyramid scheme. This is the homework. Um, Not too difficult. And now I want to look at some of these mutual fund companies. So I'm not trying to show preference towards anyone. So Morningstar, let's start with Morningstar. Morningstar is um, the company that evaluates different mutual funds. So you can get some information, and this is just kind of general, financial information. But the good stuff is going to be behind the paywall, and so you start your free trial and get your account now. Not necessarily, obviously, for this class, but if you're making mutual fund selection decisions, um, you can also look at some magazines, or you can look at a lot of times these other investment things will mention how Morningstar has rated their funds. But again, rather than just listen to Vanguard tell you how great their funds are, um, if they got a good review in Morningstar, they will certainly mention it. So let's see. So, you know, a little about Vanguard. So personal investors is where we're going to be. A lot of times these guys are into trying to reassure people because people are kind of scared right now. Um, and they're trying to, reassure people not to pull all their money out. But let's look at some mutual funds. And they're going to go through some sort of selection process and try and guide you to, a fund that they think will work for you. And so you can go, through these sites, and I'm not saying you would necessarily pick Vanguard. There's something I want to check on here. So exchange traded funds, other mutual funds, stocks and ETFs, cash options. So anyway, whatever money you've got, they want to be your person to go to it. If I'm not sure why you'd want to buy an ETF through them. Most people end up here in the mutual fund section, but that's fine. Other mutual funds. And so they will sell from other companies. Pardon me. So Franklin, there's Fidelity stuff. So, I mean, again, what they're going to do is try and compare with funds that they have under their own company. One last cough. Sorry. TD Ameritrade. Another big company. Again, they tend to do more in catering to the individual investor, but they also have stocks, options, ETFs, mutual funds. So more than 13,000. So they tend to offer other people's products too. So if you see a fund that you want to buy and you're already associated with Ameritrade, what I would try to do is I used to be associated with about 5 different companies, and it's just overwhelming come tax time. If they can be together, that's great. But a lot of times you end up with working for a company and they're associated. They use whatever company they have for preference. Um, Under TD Ameritrade, you can margin cryptocurrency trading. You can do some wild stuff that gets a bit beyond conventional, you know, personal finance investing. But, you know, just use some caution. T. Rowe Price, another big company. You may have, your family may be associated, always, your father or your mother or whoever always use this company and whatever. Not a huge difference between them all. TIA Craft, they tend to cater to educators. I think it started out as teachers something something, and anyway, you see a lot of people at the universities and stuff, um, involved with TIAA Craft. I think you could find it under here somewhere, but it's a .org, but it doesn't matter. Um, Same sort of for-profit kind of company. Personal finance, you're wasting your money with me. Retirement and beyond. So anyway, they're all going to have these same sorts of elements to a plan, and a lot of it's about education because they figure if they can, you know, they want to get you in the door, and then you know, develop you as a customer for life. So they have a lot of front end things here on their websites to lure you in, and again, find one that you think is easy. I've one of the companies I work with, they insist that I, have my funds through Voya, which is a Dutch company, and it's horrible. Their website is just absolutely frustrating. And so, but it's, I think it's because it's a European deal, but it's just, and their programs are not any better. So I guess the website, what I'm trying to say is find a website that's you're comfortable with, a company that seems like it's got a good, philosophy and the rest of that, and then go into Morningstar and make sure that they're getting the performance that they should. Um, or, even if you want to go to Ameritrade and buy anybody's mutual funds through them, you could buy anything you want to, include crypto, which again, I kind of wish I was trading cryptocurrency through these guys rather than some of the flaky companies I've dealt with, especially in the Bitcoin realm. So, um, but when you're working on your project, again, if you're stumbling, if you're having trouble, you know, go to one of these big finance websites and look at what they have to offer. This retirement 101 here, this is under BlackRock. Under Fidelity, they're going to have a huge section on retirement. They're going to have retirement calculators. They're going to have all kinds of stuff. Zero commission, see, zero commission, no load funds, all the rest of that. I mean, they're all, any of these, to remain competitive, any of these big boy funds are not going to rip you off generally. What was I going to say? So if you do see something that's useful under some sort of retirement type thing or some sort of financial thing where you type in some numbers and print you out a spiffy kind of chart, you can go ahead and um, cut and paste that and put it into your report. Don't make your report just a series of pictures, but visual aids are much appreciated and make for a better report. All right, I think I'm just rambling on now, but you can see that there's lots to be had out there in that realm. Good luck. Let me know if you have any questions, and hope everybody's staying healthy.